here with Think Tank Trading, and I just wanted to go over our beginner's guide to the market. This is just going to be a little key for you to help you get through those beginning phases when you don't really know what you're doing yet, learning the lingo, figuring out what options are, and all that fun stuff we're going to dive into. I'd like to start off by saying welcome to our YouTube channel. If you haven't subscribed or liked, please hit those buttons now for us. We appreciate it. And if you haven't checked out our Discord, the link is in the description below. Okay, so we'll just go ahead and dive right in here. Alright, the basic guide to stock market shares. This is just your basic stuff, buy low, sell high, is it a sure thing, getting familiar with filings. There's no perfect metric. That is huge in the market. There's no single number that divides good stocks from bad ones. You can't just pick the winner every day. Types of trades. So there are different types of trades, and you're going to hear these terms a lot during your trading days. So day trading multiple positions during the day. Typical trades last between minutes and hours. Look to profit from small market moves based on technical levels and market news. Short-term trading, these last anywhere from 1 day to 1 week. We have medium-term trading, that's going to be 2 weeks to a month, and then your long-term trading, which is anywhere from a quarter to 5 years and beyond, just depending on what you're doing with your portfolio. All right, on to learning the basics. In the beginning, there are many important aspects of the market. The basics include what are the best trading hours, what makes the financial market fluctuate, what types of orders are there, what are the terms used in trading. The more you know about the market, the healthier your risk profile is going to be. Don't jump right into the market without background knowledge of trading. Where do I start? Okay, start by opening a brokerage account. I've also added our Webull link in the description below. I personally like Webull the best. It has the best trading hours. You can trade from 4 a.m. to 8 p.m. Use our link in the description. You'll get 2 free stocks valued up to $1,600 with a $100 deposit. You cannot beat that return for your initial investment into the market. There are many different trading platforms available. The key is to find the one that works the best with your trading style. Do your research, figure out if you want a cash or margin account. If you do go with a margin account, make sure you understand the risks you are taking on. Margin accounts are usually for more advanced traders. If you're just getting started in the market, I would highly recommend sticking to a cash account. Now, a cash account on Webull does have a little loophole for the pattern day trading rule. Pattern day trading is basically making more than 3 day trades within a 5-day period. If you have less than $25,000 in your account, you cannot trade more than 3 times in a 5-day period. So you have to watch those day trades. But Webull, another thing I love about it is their little workaround. Since options settle overnight, you can basically day trade options unlimited with a Webull cash account, but it has to be the cash account. Okay, back to. So do your research, figure it out. All the platforms are different. They're all laid out. Many of them have internal tools, including scanners, research tools, news, guides, different charting, all kinds of stuff. So just take a look around. Like I said, I recommend Webull. If there's something that you are more comfortable with, go with whatever fits your lifestyle the best. Okay, getting a feel for the market. Once you have your brokerage account set up, try a few small, low-risk trades to test the waters before making large investments. Learn your risk tolerance. This is very important. Everyone has a different risk tolerance. Figure out before you enter the trade how much you're willing to lose. You need to know your exit strategy either way. Know your exit strategy as far as how much you're willing to lose and your price target, your PT, You'll want to know that as well going into a trade. That way, if you know your exits, you can keep your portfolio very well balanced, keep yourself trained, and mitigate that risk. All right, so don't go in too heavy on any single position. Make sure your portfolio is well diversified. And by well diversified, that's not just in different stocks, that's in different sectors, that's in different types of stocks. If you have nothing but growth stocks and penny stocks in your account, they're all going to trend together. They're all going to fall together. They're all going to go up together. So make sure you have a well-rounded portfolio and that you have some of those great value stocks as well as the growth stocks to balance everything out. Some dividend stocks thrown in there. Have a little bit of everything. That way, on the down days for the growth stocks, you've got up days for the value stocks, and you can kind of round things out that way. Taking a large position on one single play or in one single sector puts yourself at risk, and it can really hurt your portfolio if something goes bad. You never know when news is going to drop, and the market sentiment can change at any time. Basic equity trades. So in your equity trades, you have a few different things going into it. Your limit order. Placing a limit order is basically saying, okay, I am willing to pay $1.04 for ABC stock, and I'm not willing to pay a penny higher. When you enter a market order, even though the price is at $1.04, it could end up filling you at $1.07, just depending on the bid-ask spread on that. So I highly recommend always placing things as a market order. There's also your stop loss. I highly recommend getting that stop loss in place as soon as you enter the position. If you have that stop loss in place as soon as you enter, you're not going to forget about it later. You're not going to forget to put it in, and you're going to have that there to mitigate your risk from the very start. All right, so finding your trading style. When you start out in the market, the first thing you need to do is figure out your personal trading goals. Are you looking for an extra source of income? Do you want a long-term steady growth? How much time can you dedicate? Do you plan to trade securities on a daily basis? What trading style fits your life and time constraints? Knowing this ahead of time will define your trading style and really help you hone in on what you're looking for in the market. So the different types of stocks we have listed here, you've got your blue chip stocks. These are your large cap, long term, solid history of growth, basic. You've got your dividend stocks. These are going to pay a dividend, some monthly, quarterly, annual, just depending on the stock. Highly recommend having some of these in your portfolio to help round things out. Defense stocks are less sensitive to market conditions. These are your stable stocks that even when there is a correction in the market, they tend to stay pretty safe for you. But on the other end of that, they aren't really going to grow a lot as well. Growth stocks, I've mentioned those before. These are stocks with expected earnings that are where you're expecting the company to grow rapidly, basically. So a lot of new companies, some are older companies, but are just getting into the growth sector because they are just booming right now with the economy. And you've got your penny stocks and your cyclical stocks. So penny stocks, this says prices under $5. That's, hearsay. Everyone has a different variant on that, but they're basically based on the market cap size. But penny stocks can be very volatile. You have to be ready for them to move 5 to 10% on a daily basis. So to be in penny stocks, you kind of have to have a strong stomach, but they can be really, really, really good for you if you stay with them and if you do your research, do your due diligence, and find the right ones out there for you. All right, so what type of trader are you? Depending on your work schedule, lifetime constraints, kids, practices, whatever you have going on in your life is going to define what type of trader you're going to be. So are you a day trader and a scalper? Those kind of go together. Scalper basically is playing one candle or, one little run. Positions open and closed within seconds or minutes. Day trader is, fits into that category, but it's positions opened and closed on the same day. Your swing trader holds usually 1 to 4 days. I consider swing traders up to 2 weeks usually. And then a position trader is somebody who is holding those securities for very long periods of time, for months, even years. All right, so terminology, learning the lingo. This is huge in the stock market right now. If you come in and listen to a conversation without having any background knowledge of trading, you are going to be blown away by the lingo that's used. It's almost like hearing a different language. So take a little time and get familiar with some of our common terminology. So you've got your bid-ask spread, which is going to be the difference between what people are asking for the stock who already own it and what the bidders are bidding to buy that stock. So you've got your bull market, which is going to be a market that wants stocks to go up, and your bear market where they want stocks to come down. You've got your limit order that we went over before and your market order. Good till canceled is basically if you were to place a limit order on a stock and keep it open, extending that day of trading. That is also viable when it comes to your stop loss. When you place your stop loss, you want to make sure you have that good to canceled in there. Volatility is something that you want to know a little bit about. Knowing volatility is basically how quickly a stock is expected to move. We went over a little bit about dividends, day trading, sector. As I was speaking before about how you want to have a well-diversified portfolio, that means there are different sectors in the stock market. You've got your goods and services, you've got your automotive, you've got your business, you've got your real estate. So just pay attention to the sector and make sure that you're not always heavy in one sector because they do tend to trend together. Margin, we kind of touched base on that earlier. Portfolio, that is, your collection of investments. Let's see here. So averaging down, that would be one I would want to touch base on. So when you enter a position, you never want to enter the position at the full amount that you want. You never want to go in what we call top heavy. So when you first go to enter a position, I usually enter with about a third of what I would want to see total for that specific position. Okay, so there's quite a few others on here, some that we've gone over, some that we haven't, but I highly recommend taking some time to go over many of the different terms that we use here in the stock market. So I'm going to go over ETF and index funds. What is an ETF? An ETF, or exchange traded, is a marketable security that tracks an index, commodity, bonds, or a basket of assets like an index funds. Unlike mutual funds, an ETF trades like a common stock on a stock. An ETF can be described as a pooled investment vehicle, which units that can be bought or sold. Okay, so just to simplify this, an ETF is a group of stocks all together that are in one group that you're investing into. Kathy Wood and her ARC ETFs are probably the most famous. Highly recommend you looking into those. Those are some great ones that I love to trade. So index funds are pretty similar as well. They hold the same securities and kind of have stocks and bonds together there. All right, common mistakes for new traders. Investing before you're ready. Never invest before you're ready. That means financially as well as mentally. The mental game of investing is more than you realize. So make sure that you know what you're in for, but it can be a fun ride. Setting unrealistic expectations. Have reasonable expectations for stock market investing. For instance, the market's long-term average annual return is close to 10%. Basically, if you're here to hit the lottery, you're in the wrong place. If you're here to grow your money over a period of time with well-researched investments, then you are in the right place. Not diversifying your portfolio. We touched base on this a little bit earlier, but having a well-rounded portfolio is so important. I can't stress that enough. Letting your emotions affect your trades. Emotions can get really involved in trading, and sometimes you just get overly excited about something, or a past trade went so well that you want to see this next trade go that well, and you end up holding way too long. You end up losing your profits. You end up down on the stock. Try and keep your emotions out of it as much as possible to stay disciplined. It is very important and also very hard to do. Risk management. Every trader has their own risk tolerance. This is something you have to figure out for yourself. We're all here for a different reason. We all have different limitations and different things going on in our lives. So make sure that your risk tolerance is set to what you need it to be and what you're here for. All right, expecting past performances to continue. Like I was saying before, you have to treat each trade differently and not expect the same results that you had on your last trade. Setting unrealistic expectations that every stock is going to yield the same gains as your last can cause you to make mistakes and often lose by holding too long. Okay, introduction of options, my favorite. All right. A call option is a contract that gives the buyer the right but not the obligation to buy 100 shares of the underlying security at a predetermined price called the strike price. When a predetermined period of time, this will be your expiration. Within a predetermined period of time, this is going to be your expiration date. The price of the contract, known as the premium, is always multiplied by 100. This means if the premium is 2.45, the buyer is paying the security holder $245 for the right to buy 100 shares of the stock if it reaches your chosen strike price by the expiration date. We never actually exercise these options. This is what the contract is designed to do, but we're usually just in it for the premiums. We just like to see those premiums go up a little bit when the stock goes up in price, and then we sell. We usually don't hold until the expiration date, and unless it's something that you really, really want or something that went up like crazy, there are situations where you might want to execute an option or exercise your option, but most of the time we're just trading the premiums. A put option is very similar to a call, but the exact opposite. So a put, you want the stock to go down, and a call, you want the stock to go up, just to make it simple for you. Purchasing your first option contract. Options trading has a much higher risk to reward ratio than regular trading of shares. Options are much more volatile and require a basic understanding of the stock market. Trading options is not for everyone, and knowing your own risk tolerance is the most important thing you need to know before entering a trade. Don't risk what you cannot afford to lose. I will say that again. Do not risk what you can't afford to lose. Since each option contract is representing 100 shares of the stock, they can move very quickly, and there are several important factors that can affect the premium. For your first contract, find something low risk with a premium under $100 and purchase just a single contract. Seeing a security move 10 to 20% in seconds for the first time can be very scary. So starting small to get a basic understanding is extremely important. Trading options, if you don't know what you're doing, can be the quickest way to wipe out your portfolio. Always do your own due diligence and understand the risks associated with trading options. They can be extremely lucrative, but extremely risky. So keep those option positions small, and only a small percentage of your portfolio should be allotted for options trading. Okay, so a little terminology about options. You've got your options chain. This is your list of contracts used for quoting the options in a list format for the available strike prices and expirations for the stock. So this is basically going to be your list that's drawn out showing You know, you want Snapchat to hit $70 by this expiration date, or you want Apple to hit $150 by this expiration date. All of those are going to be listed in your options chain. They all look a little different depending on your platform, but usually pretty easy to navigate. You have your monthly options and weekly options. Not all stocks trade weekly options, but many do. If you don't have the weekly options available, then go for the monthly. And I highly recommend sticking to monthly as much as you can, unless it's for a scalp or a day trade. Your weekly options are going to have higher theta and implied volatility, which we'll go over in just a moment. But basically, they don't have as high of open interest as well. So I would recommend going for monthly as much as possible, but the weeklies are fantastic for short-term trading, short swings, day trading, overnight holds, and that kind of stuff. All right, so open interest is the interest open for an option, the total number of outstanding or open positions that are in effect on any given day. Seeing a higher open interest is always key. When you see that higher open interest, you kind of know that that's probably a good position to take. That contract, a lot of people want it, and a lot of people are selling it and buying it. Option expiration. That's just the day that the contract expires, and as they are getting closer to that expiration, is when you're going to see that time decay, which is going to be referred to as the theta. And exercising an option. We just went over that briefly as well. All right, implied volatility. This is a big one. IV is the estimated volatility of a security price. In general, implied volatility increases when the market is bearish and decreases when the market is bullish. It can also be affected by an upcoming catalyst or event. This is due to the common belief that bearish markets are riskier than bullish markets. Implied volatility is a way of estimating the future fluctuations in a security's worth. So basically, if you see an option contract with super high IV, then I would stay away from it. IV can dramatically change that premium, so you want to be careful when entering into option contracts with a high IV. IV crush is a term that we use that describes a scenario in which implied volatility decreases very quickly, which directly affects the contract premium. Usually this happens after an event has passed, such as earnings or an FDA catalyst. So an example of this was not too long ago. I've been in CCXI, and it had an upcoming catalyst, and the IV was like 350%. I sold an option $7 out of the money. So the stock was $13 at the time. I sold a $20 call option that was going to expire in a few weeks for $250. And then the FDA date got pushed back, and that IV dropped down to nothing. And even though the stock didn't go down in price, it actually went up in price a little bit. That option contract went from $250 to $35 overnight just because of the IV. All right, so the Greeks. Your delta represents the sensitivity of an option's price to the change in value. So in basic terms, this is if your stock goes up $1, your delta is representing that move. So if your delta is 0.78, for every dollar that your stock increases, your option's going to increase by 0.78, which is $78, because we're always multiplying that by the 100. The theta, which I've mentioned a few times, is referring to the time decay. Your gamma is relative to your delta. So after that dollar goes up, then your gamma takes into effect to change the delta for the next increase. Your vega represents how sensitive your option is going to be to IV. And then your real represents how sensitive the price of an option is to interest rates. Okay, so here is my theta curve time decay chart. This is almost shocking when people see it for the first time, even people who have been trading options for a very long time. Theta is not linear. The effect theta has on an option's price is not straightforward. It does not reduce the price by the same amount throughout the life of the contract. As the days pass, an option has less time to make a move and thus will be worthless. So if you take a look at this, 120 days out, you have a very slow curve coming down a little more in the 60, a little more down to the 30, and then those final 30 days you have this rapid expiry that you need to be careful with how theta can really affect that. So say by combining your option theta with your delta, you can calculate how much movement we need to cover our daily losses. Say your delta is 0.24 and you have a theta of negative 0.06. So we know that as long as the stock goes up by $1 within 4 days, we will break even, unless you're in that last 30 days and your theta is going up like crazy, and then it can change on the daily basis. But basically, when you look at this, you want to make sure, if it goes up $1 that day, you're going to lose 6.06 but gain 0.24. So in that 1 day, your net gain is the 0.18. Risk management, knowing your plan and sticking to it. Hedging your position. A hedge is an investment that protects your finance from a risky situation. Hedging is done to minimize or offset the chance that your assets will lose value. There are many different ways traders can hedge a position. Many traders hedge by purchasing options on ETF or index funds in the opposition to their underlying security. So basically, if you are bullish right now, there are bearish ETFs that you could purchase an option contract on to hedge that position. Another way we like to hedge is by selling calls against our equity. So when you have a huge spike in equity and you sell a call against it, you get to collect that premium as the stock goes down. So it really hedges your position in a great way. You can also straddle a position to reduce your risk. Although this will reduce your max gain, it is also a much safer way of playing options. Straddling is buying both a put option and a call option for the underlying security with the same strike price and the same expiration date. Rounding out your portfolio. Diversify your investments. Make sure your portfolio is hitting many different sectors of the market as well as different types of securities. So we went over this a little bit before. Keep that well-rounded. Never go all in. We talked about this as well. Having your portfolio 100% invested can be harmful. Always make sure you have cash on hand. You always want 30 to 40% liquid. Well, at least 25 to 30, but you always want to have a liquid position, cash position, to be able to average down, to be able to get in on a new trade depending on what happens. But you never want to be all in. You always want to have a little wiggle room in your portfolio to move some things around and make sure that you're getting the best price you want for your stock. All right, options mania, looking for a lottery ticket. Many new investors see these massive gains from large option positions and think by going all in they can hit the lottery. This is the biggest mistake new investors make when learning options. Although options can be extremely lucrative, they can also be extremely dangerous. Only allow a small portion of your portfolio to options contracts. Having more than 10 to 20% of your portfolio in options can severely hurt your portfolio if market sentiment changes. Knowing your risk tolerance, we talked about that. Cutting your losses, you have to know when it's time to cut the losses. This is difficult for each trader. Find out what risk levels work best for you in your trading strategy and stay disciplined to that. Holding for more. Oftentimes we find ourselves trying to hit the same returns we've had in the past. After seeing 100% plus gains, 20 to 30% doesn't feel like enough anymore, and we try holding for more. This can quickly take you from green to red. So make sure you're taking profits, trimming on the way up, and constantly locking in those 20 to 30% gains. They add up faster than you realize. FOMO, fear of missing out. This is huge. So comparing traders, the FOMO effect. Trader with a plan. Plans trades, keeps a journal, has confidence in their strategy. Trader with FOMO. Reacts compulsively, jumps on trends, fears missing opportunities. So step one with your trader with a plan, you're going to conduct your analysis, follow news, set a comfortable risk to reward ratio, use sensible stop loss and profit take levels, and follow a plan. Keep a log and achieve your trading goals. So trader with FOMO, on the other hand, takes opinion as fact, follows rumors, considers the upside and maximizes exposure, enters risky positions, cuts or panics, closes out, repeats. Has no plan, doesn't keep along, FOMO takes over. So just be careful out there. FOMO is real. You will feel it at some point or another, and just be careful. Don't let those emotions take over and get you into a position that you don't want to be in, and then ends up turning on you, and just be careful. All right, the best investment you can make is an investment in yourself. The more you learn, the more you'll earn. Warren Buffett. All right, guys, thank you so much for joining me here today. Again, if you finished this video, followed it through, please hit that like and subscribe button. Jump into the Discord. I'd love to help you. If you have any questions, reach out to me anytime. My name is Emily, and I'd love to help you guys out. So thanks so much for joining me today and watching my intro to trading, and I will see you all again soon.